Hello and welcome back to Core Finance. I'm Matt Brown. I am joined by Nicole Elliott, who is a technical analyst and a private investor. Puts her money where her mouth is, hopefully. We're going to do 3 segments today. So we're starting off with the first segment, which is 10-year Treasury yields. But before we do that, how are you today, Nicole?
I'm all right, and I'm quite keen on these bonds, actually. I'm a sort of bond vigilante at heart. And I think what's really interesting is that through readers of my column in the Investors Chronicle magazine and that, they, over this last calendar year, have become so much more interested in bond funds. Fantastic. Which is sort of counterintuitive, isn't it? Because we all know that the Fed is going to put up rates, and we all know that interest rates are stupidly low, and you've got to be a moron to buy anything at this price. And yet these people are interested, and they are buying. And the fund managers are launching new bond funds on a regular basis so far this year.
Why do you think that is? Is it because people have had enough of equities, they're trying to diversify, or is it just chase for yield? Is it a safe haven play, potentially, do you think?
I think it's a couple of things here. One is that I think they're becoming more confident in their knowledge of how a bond works. It's a bit like a dividend, if you want to think of it like that, except, you know, your capital doesn't suddenly slump, you know, as a share price can just drop, what, 66% the other day.
For Provident.
Exactly. Do you know what I mean? Bonds don't work like that. Yes, you know, but if you hold them to maturity, you will, unless the company went bankrupt, you will get all your capital back. So I think they've grasped that concept, and you are buying for yield. The second one is that the stock market rally is very long in the tooth. I mean, most of them bottomed in 2009, and now we're 2017. So that's a long time.
Yes.
And I think a number of people are getting a little bit worried that it's getting a little bit stratospherically expensive there as well. But above all, it's just gone on for too long, that something's going to happen. And so I think it makes sense as a protective tactic to take some of your money out of equities and into bonds. And what's happened with the yield on this 10-year Treasury that we've got going back to 2007, when we were up at 5%. Incredible. And that's what people still think is normal. And I think that's the third cornerstone of this new type of thinking, is people are beginning to realise that perhaps 5% yields are not normal anymore.
Yes.
They're not there. They haven't been there
not even,
for a long time, a decade.
Even high yield and high risk, you know, to see 5% is incredible. When you're seeing some low-rated high yield bonds trade with such low yields, it's the new normal.
Exactly. I think, and it's beginning to sink in after a decade of downward trend in this particular bond, and you can see the 2 lines. The top line, actually, is the trend from October 1987. So, I mean, that's 30 years and counting.
Yes.
And so I think people are beginning to also grasp this new rules that we're working under of inflation that is regularly below central bank target. In other words, they're failing at their jobs, failing miserably on, you know, for those who have to target it. Yeah. And look at Japan. I mean, they haven't been anywhere near for about 20 years.
Oh, gosh, no.
You know, the ECB hasn't been at target for at least, I think it's almost 5 years, on and off. And so has the Fed. And in fact, the data out yesterday showed that the Fed's preferred inflation number, that PCE, is 0.9%. I mean, it's less than half of what the target.
Exactly. It's incredible.
So, I mean, we're nowhere near.
Target. They need to reassess the target.
Exactly.
Right,
and with that, you also need to reassess what is a decent rate of return after inflation on any security you might own.
So finally, 10-year Treasury yields going lower.
Lower.
Fantastic. Nicole, thank you very much.